Okay, good evening and welcome back everyone to our live market analysis for the Nordic markets. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we're going to be going over, like we did a few weeks ago, where the current Nordic market sits, taking a look at everything from a technical versus statistical analysis perspective, and giving you a view as to how we're looking at the current market, especially going into earnings season, where we're going to have a fair amount of the Nordic market reporting earnings over the next couple of weeks. So let's go ahead and get started. But before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off by just reviewing our options education agenda and what we still have coming up before we do a broader Nordic market review, taking a look at the major indices here in the Nordics, how they're performing in comparison to each other, where we see some rotation within the major markets. And then taking a look at economic indicators, which will also take a look at some sector rotation as well, to take a look at which sectors are outperforming here within the Nordic markets before we look at some of our trade ideas, and then showing you the new options trading course so that you can access more of the information to allow you to take what you've learned and apply them to using the equity markets, using the OptionsPlay tool here in the Nordics. So as far as our options education calendar is, if you're on this webinar today, you're automatically registered for the whole series of education. But if you're watching this as a recording, if you're watching this somewhere else and you're not subscribed to this group and you want to join us on these sessions live, you can click on trade.optionsplay.com/OMX to register for this series of webinars. Today, we're doing a market outlook series. This is where we alternate between looking at the markets and doing education. So every other week, what we do is we switch up the topic. This week, we're doing a market outlook, giving you a sense for where the current markets are trading. And then the next session we do will be an educational session. Next time we're doing long-term investing with options to give investors a better understanding as to how to leverage options for those longer-term views, specifically buying long-dated options, how you can look at buying long-dated options, which expirations and strike prices should you look at, and what tools do you have in order to reduce the cost of those long dated call options. So I hope that you'll be able to join us here in 2 weeks for that one session. It is a very, very popular education session, investing in longer term with options. So the primary question that I want to explore here during today's session is, are the Nordic equity markets starting to be overextended and at risk of a pullback? That is the theme that we're starting to see here across equity markets, as there has been a lot of euphoria across the globe, especially with vaccines being distributed at a fairly rapid pace in different countries. You know, the Nordic markets are a little bit behind in terms of deployment of vaccines, but largely equity markets have priced in this reopening, if you will. Equity markets have been very optimistic about the rebound and the economic recovery. And we have spent quite a few months of what has been a very strong rally, yet the fundamentals in the economic indicators have not been that strong. We really need a time for the economic indicators and fundamentals to catch up here. So the question is whether this rally that we're starting to see here is a little overextended. So before we actually get started, I just want to do a quick poll here. Could everyone please bring up your chat window, which is at the bottom of your screen? And please type yes if you believe that markets are overextended and it's at risk of a pullback. And please type no if you think markets can continue to move higher from here without a pullback. I just want to get a quick poll here for the audience. Okay, so the vast majority of investors here have said yes, that they believe that the markets are overextended and are at risk of a pullback. A few of you have said no. So when we look at this, this type of question from the, when we're looking at the markets here, we really have to look at it in a few different ways, right? We don't necessarily want to just say equity markets as a whole. There are multiple equity markets. You have 4 major Nordic markets. You also have quite a few different sectors. You have 10 different sectors within those equity markets. So many times when we say that we may expect a pullback, that still means that we may expect a stronger pullback in specific sectors, and at the same time, we may expect other specific markets or specific sectors to remain defensive or remain strong, even if we do receive a bit of a pullback here. So today's session, what I want to do is I want to share with you my technical research, my charts to help me inform my decisions as to whether or not you believe that there's a pullback or not. Where do you want to look for opportunities in this market? Where do you want to look for long opportunities? Where do you want to look for short opportunities? Or which markets are at the highest risk of a pullback? That's how you want to position yourself. You don't necessarily want to have a binary view. And I see a couple of people here have answered yes and no. And that's exactly the type of mindset that I think is important to come with to the current market conditions that we're in. So let's first start off the Stockholm 30 index, the OMX S30. The OMX S30 has had a very nice run here from about 1950, where it had a slow grind here to the upside, a big move to the upside. And despite almost no consolidation after that big move, it continues to rally higher here. So the one thing I want to point out to investors is that this last rally high here is when we start to see some negative divergence. So what we're doing is we're making a higher high on price. Momentum is no longer confirming those new highs. And RSI, as you can see, well above the $70 level on the daily chart and well above the 70 level on the weekly chart. This is telling us things are pretty overextended. And this is starting to certainly remind us of what we saw right before the coronavirus sell-off, where we had a fairly extended period of time where markets just stayed positive. You had the very big move here to the upside before you had the big crash. Now, I'm not suggesting by any means that you're going to get a big crash here, but what you tend to see is that these type of markets, when you have this negative divergence, the negative divergence in itself does not mean that markets are going to pull back. It simply means that the risk here is higher. And it does mean that this can actually continue to happen for even longer time. We see this a lot where markets will make even a newer high, so a newer high in price, and continue to make further negative divergence. This can happen for multiple months. And the thing is that the more this happens, the longer this negative divergence goes on for, the more likely you see a very fast and violent pullback. So this, in my opinion, is a relatively small negative divergence. That's really the first warning signal that we get. So usually this is not necessarily a good reason to short the markets. These are good reasons to start considering taking profits on long positions. This is a good time to sell covered calls up here, so that because if markets kind of continue to consolidate a little bit or move slowly, that you're able to take advantage of that sideways movement. But if it does accelerate here to the upside, that is also, those covered calls allow you to take profit on your equity positions. So that's how we're currently viewing the Stockholm 30 index, which is, out of the Nordic markets right now, the strongest, but starting to show some signs of exhaustion. So as you're looking for opportunities, this is one of the markets that become more difficult to continue to look for long opportunities, where you have to be far more selective. When we look at the Copenhagen 25, we talked about this last time, where we have this triple top. So far, this triple top has broken out. So we had this double top around 1700 or so that has acted as resistance. We've now broken above that level. But one thing I do want to point out here again is that you have, this one you actually don't have negative divergence, right? Because what you have is on the daily chart, as the price made a higher high, momentum did confirm that new high. So the Copenhagen index is not at risk the same way as the Stockholm market of a pullback. If anything, pullbacks will likely be relatively shallow. You do have some divergence here on the weekly chart here. As you can see, as the weekly chart made a higher high, you start to see that divergence here. But again, things are pretty shallow in terms of the trend higher here. So even if you do get a pullback here, it is likely going to be relatively shallow. If you get below 1640 or so, which is roughly the same price here, in the 1600 to 1640 level, if you do get a pullback here, that would probably be a very good buying opportunity longer term, especially if the second half of this year or the second quarter of this year starts to look very strong here from an economic recovery. And we're going to take a look at some of those economic numbers here as well to inform some of our decisions. So when we look at the Stockholm market, It is far more overextended here than the Copenhagen market, not overextended. As you can see, RSI still around 60, so it has plenty of room to grow both on the daily and weekly chart. The Stockholm market, far more overextended, far more signs of exhaustion, and in my opinion, at a bigger risk of a pullback than the Copenhagen market. And then when we look at Helsinki, this is an interesting market because Helsinki has been on a very just straight grind higher. There isn't you don't have big moves to the upside. It's just a very consistent, almost boring play, if you will, here. But it is by far right now the most steady of all of the Nordic markets. It has started to lose some of this momentum here. As you can see, we're starting to see higher highs in terms of price, but momentum is no longer making higher highs. It's actually moving lower here. This is another sign that this is starting to, this move, this big moves we've seen here is starting to get a little exhausted, starting to lose some of that momentum here. But again, this type of exhaustion can continue to go on for quite some time. You can see this last many times weeks, if not months. So this is one where you've remained, I would say, more cautiously bullish, and you just want to be very tactical with it, because as you can see, there are many small pullbacks within this larger primary trend. And you just want to be aware of that you see this orange line, as you can see on my chart, that's the 21-day moving average. Effectively, when it gets below the 21-day moving average, those have been good buying opportunities. So this is one where you have to be selective. If you're bullish on this particular market, wait for pullbacks below the 21-day moving average. Those are your best opportunities to seek long positions here in this broader market, especially as Helsinki so far has remained fairly strong. And then lastly, we'll look at Oslo. Oslo has, really rallied here over the past since the November election. This has driven oil prices substantially higher since then, and that's what's been driving the Oslo markets, which is obviously very heavy in oil and gas. But we have had also a pretty extended move here to the upside. We started this move around 750 or so. We're now at 937. We have this what looks like a bit of a double top here. As you can see, you also see that same sign of exhaustion here. Higher high in terms of price, lower high in terms of momentum. So starting to lose some of that momentum here. You did make a higher high, you did make a higher low here, but my guess is that it's going to have a tough time getting back above this 950 level here or so, roughly 945, 950. If we do get back above that level, then it could potentially continue to rally. But if we look at oil prices, I don't particularly see a strong indication that oil prices will rally substantially higher from where it is today. And just to pull up a chart here for oil to show you, this is the U.S. crude futures. I'm using WTI, the crude U.S. crude futures as a gauge for crude right now. We've had a pretty big move up here today, 4.5%, starting to break out here. But I do think that 65, 66 is probably likely going to be a long-term resistance level here for crude. As you can see, this goes back quite a bit even before the pandemic. 64, 65 generally tends to be the higher end of the range. This is OPEC tends to keep oil in this particular price. It doesn't like to get it much higher because in the $60, $65 range, it is profitable for the oil producing nations like Russia, the Gulf nations. However, when you look at the North American shale producers, it is not profitable for North America and Canada, especially the fracking and the shale producers at 65. It's barely profitable for them. So OPEC has a fundamental reason why they want to keep oil around these prices. And Norway, is profitable at 60 because their cost of bringing oil out of the ground is substantially lower here. So that is the one reason that I do see potentially Oslo continuing its rally, but it's certainly starting to show that it's losing a bit of momentum here. This wouldn't necessarily be my top choice because, again, I do feel that oil has some limits as to how much higher it can go from where we are right now. So that's how we're currently looking at the four major markets. Like I said, the most constructive one for me right now is Copenhagen breaking above those resistance levels, starting to form a bit of a base, has that potential to go to the upside, especially as both the daily and weekly charts are not overbought and have quite a bit of room to the upside. Helsinki also slow grind, but I certainly think that tactically speaking, I would wait for a pullback below the 21-day moving average to move higher, but it is losing some momentum here. So I would say it's my second choice. But then, when we look at Stockholm, this is really where the performance has been here for Stockholm, but I think that we have already outpaced a little bit some of the performance here for Stockholm. It is very optimistic, I would say, the Swedish markets. And right now, I think we need to see the data catch up with where equity markets are starting to price in. And lastly, Oslo, very heavily tied to oil. Keep an eye out on that. I do think that there's a cap as to how much higher oil can go from here. So taking a look at the economics here, when we look at Swedish economic numbers, they're not particularly strong. Industrial production in February rose by 2.5% here. So it's still positive. That's good. We've largely seen positive results from industrial production since late of last year. We had a pretty strong end to the beginning of last year and to the end of 2020 and beginning of 2021. However, that's come down quite a bit here in January and February. So industrial production, while positive, not overly strong. We would really like to see industrial production continue to move higher here, because this is the one part of the global economy that is extremely strong right now, industrials. And we really want to see Sweden be at least on par with that. Right now, it's not quite there. And the one part that is concerning to me is that services is not bouncing back the way that we really would like to see it by now. And when I say by now, I know Europe is still grappling with coronavirus a little bit more heavily than other parts of the world. And this is the segment of the market that we really need to see strong recovery in order to have confidence that for example, the OMX S30 that has been optimistic and forward looking, that the data is justifying the move that we've seen here in the Swedish equity markets. And so far, the economic indicators are not particularly strong. And I would say that some of it is probably due to the fact that Sweden right now has a pretty significant bump in terms of coronavirus cases along with the rest of Europe, but certainly at a steeper rate, and certainly over the past few days have taken a strong spike here to the upside versus the rest of Europe that is starting to taper off and slow down in terms of the growth in coronavirus cases. So this is one aspect of Sweden that I do think is at risk, especially when we look at the fundamentals of the economic picture. And then when we look at the high frequency data, like the COVID cases and the mobility data, that's part of where I also see a higher risk of Stockholm pulling back here when we look at the data. And then when we look at Norway here, this ties into the slowdown that we've started to see in terms of momentum here for oil, or the outlook here for oil, is that Norway's GDP has started to taper off. Very strong end of last year, but over this year has been very choppy, and we've had multiple months, month-over-month contraction of GDP here for Norway. So, when we look at the economic indicators here, out of the Nordics, the numbers have not been particularly strong. They've been actually starting to weaken a little, which is in line with what we're seeing out of Europe. Europe has continued to struggle with coronavirus, and that has had an impact here on the economic recovery. So the data, in the US, what we have seen is that equity markets have rallied, but the economic data has now started to catch up and confirm the optimism that the equity markets have priced in. In the Nordic markets, we've seen the optimism from the equity markets, but the economic data and the fundamental data has not quite caught up yet. So that's part of the risk that I see for these markets to continue to move higher. And like I said, markets can continue to move higher because, remember, equity markets are forward-looking. Equity markets are not looking at what is the data today. The equity markets are looking at what do I expect a market, the the data to look like tomorrow and next month. So you do have to make sure that you don't confuse the two. But the longer this goes on for, where equity markets continue to rally, but the economic data do not catch up to it, that's where you have the risk of a higher pullback or a more violent and faster pullback that you're going to see here from the equity markets. So when we look at those markets, those are some of the concerns that I have. So like I said, different markets have different potential outlooks. So even though you're concerned about a pullback, you may still see that that pullback opportunity exists in certain markets. But then there are other markets like Copenhagen and Helsinki that look a little bit stronger, that as you're shifting maybe some money out of Stockholm, you start to shift some money towards Copenhagen and Helsinki to kind of take advantage of that shift or rotation that we're starting to see within the Nordic markets. And then when you look at the sectors, you also see a fair amount of rotation here within the sectors. So let's just take a look at how the sectors currently look. And I'm just pulling this up here on my other screen so that I can speak to it. So, here's the major ones that we currently see here. And let me make sure that I pull up the daily chart here. This is actually, hold on one second. If I'm not mistaken, I'm looking currently at the weekly chart. Okay, so what you have here on your screen is a weekly chart. And let me bring this over here. And this will probably be a little easier for me to show. So this is the sector rotation model here for Europe. And what you largely see here is that in Europe right now, financials is, and just for those of you that are relatively new to sector rotation, what it does is it gives you a sense for which sectors are in the leading category, which sectors are in the lagging category. So you know which sectors are outperforming, which sectors are underperforming. And then you have what's called weakening and improving, giving you a sense for whether sectors are getting better, or meaning starting to outperform, or are they starting to underperform. And what you generally want to see are sectors that move in this particular direction are the ones that are improving and starting to see outperformance, and the sectors that are moving in this particular direction are the ones that are underperforming and are going to perhaps lag behind. So when we look at financials, as you can see, it kind of had a pretty interesting move here, but started to outperform here again. This really comes down to the rise in terms of interest rates, a bit of a stability in interest rates, and now starting to outperform here. This is a weekly chart. So this is looking at the past 21 weeks. Roughly, and we're seeing financials continue to outperform, and also industrials. This is the what we're starting to see here for the rest of the world. Industrials coming from weakening back into the leading category here. So when we look for opportunities, financials and industrials are two places that you want to lean towards, and you're looking for outperformance. Or if you're concerned about a pullback here, allocating more capital to financials and industrials will likely provide some defense. So perhaps if markets do pull back 5%, you might see industrials and financials maybe only pull back 3% and outperforming the markets there. So that's really important to pay attention to. You also see consumer goods and telecommunications start to move in the same type of direction here. Consumer goods also fairly strong here in terms of a sector, telecommunications. This is what we call more of a stealth rally, meaning you don't really see much of a rally here. It's kind of very choppy. It's not a strong rally here, but it is starting to improve. It's not one that I would put on my watch list just yet. It's one that I would put on my watch list, but I wouldn't quite commit any capital to just yet in terms of telecommunications. Oil and gas has had this pretty big move here to the upside. Pretty big leading since the November elections here of last year, but have really started to underperform here over the past few weeks. This is one, if oil prices continue to climb, this is one where I do expect that oil and gas will start to outperform, and that's really where we could see the Norwegian markets outperform. Basic materials, this is one that has led the markets, but have started to fall behind, unlike industrials. So right now we tend to bucket materials and industrials together, but we're starting to see outperformance here specifically from materials, and start to see a little bit of outperformance here for industrials, underperformance here for materials. So be very careful when you're looking at, stocks. Many times industrials and material stocks kind of blend together, and many of them kind of have overlapping businesses. But especially when you're able to differentiate between the two, industrials right now look stronger than materials. Consumer services, not particularly strong here, as what I was showing you before. The services side of the market, not particularly strong. We don't see the economic recovery on the services side here in Europe just yet. So even though it is continuing to be in the weakening category here, technology also not particularly strong here. Technology coming up higher here into the leading category, but over the past few weeks have really started to come back down into the weakening category. So while technology had a decent run, starting to fall back behind. Healthcare, very weak here. Healthcare, especially if you look at AstraZeneca, a lot of these pharmaceutical stocks not doing very well right now, still back in the lagging category, and utilities also not a very strong sector here for Europe. So when we look at these types of markets here, it's very important to pay attention to which sectors are strong. So especially when you're concerned about a pullback, you want to know, well, where do I see the highest pullback here? And this is it on a, this is it on a daily time frame. This is the past 21 days looking at this data here. And what you have here is technology leading, but starting to move a little back towards the weakening category. Utilities was leading, but starting to fall back behind. Industrials, as you can see, still very strong. This is the past 21 days. Consumer staples starting to get a little stronger here. Basic materials getting stronger here. So industrials and materials are both on here, but as you can see, industrials stronger than materials. You do have technology and utilities that have performed, but starting to come back a little bit towards that lagging category. And then you have oil and gas continuing to decline, telecommunications continue to decline, financials starting to creep up a little bit here, perhaps getting back into that improving category and maybe getting back into leading, but not quite there just yet. And healthcare, as you can see, tried to gather some strength, but is falling behind here again. So depending on whether you're a short-term or long-term investor, that's how you can use the sector rotation model to give you a better sense for, within the sectors, where do you want to position in there. So with that, I think what we want to do is just take a look at quickly the earnings season that's coming up, because we do have major earnings coming up on the 22nd and 23rd of April, the 27th, 28th, and 29th, and then a little bit on the 5th and the 6th. That's where you have the bulk of the earnings season coming up here over the next couple of weeks. So these are all the symbols that are reporting on those dates. And what we have built here is, you see how some of these are in green and some of these are in yellow. This is based on liquidity. So the ones that are in green are what we consider fairly liquid symbols from an options trading perspective. The ones in yellow are somewhat liquid, and the ones that are not colored at all, the ones in threes, are basically ones that are not liquid. So those are the ones that we generally would try to stay away from, because whenever you're trading options around earnings, they tend to be very volatile. You tend to prioritize your ability to get in and out very quickly, especially after or before an earnings event. So that's why we prioritize liquidity when we look at the earnings season. So you might want to take a look at some of these names on the screen. Maybe some of them you have a particular view on, whether you're bullish or bearish on, or perhaps they're in a specific industry or sector that you think might be outperforming during that time. So this is one that we are going to pay attention to this is one that you should pay attention to if you are trading around earnings. So with that, what we'll do is we'll take a look at some of our ideas here for today. Let me just pull that up so that I have them on my screen. We were looking at a few different possibilities here in the Nordic markets, and these are all looking at some of the sectors that we refer to that are fairly strong here. Let's pull up a watch list real quick. I do want to take a look at some of the Danish symbols that may be particularly strong here, but the ones that I'll pull up first are, well, Axe Food is one that we are currently taking a look at. And the reason that I kind of like Axe Food is that it's not a stock that's overextended. As you can see, it's not trading at all-time highs. It is trading at a fairly reasonable multiple here as well. And it did manage to break back above that $205 level that has been roughly resistance and support here. And it's pulled back all the way to this level. So the risk to reward looks fairly strong here to the upside, because if it breaks back below 205, you only have about 10 crowns or so of risk to the downside, but then you have upside of back to about 215 or so, or less than 10 crowns, probably about only 5 crowns or so of downside with about 10 crowns of upside here. So this is really where, you know, you're looking for a potential bounce here, especially with earnings coming up in 8 days. That could be the catalyst that you need for this to push substantially higher and back towards the all-time highs around 219 or so. So the trade structure that I was looking at is to use a call vertical here, but going out to June and buying a 205, 220 call spread. That cost me 555 crowns. And this is risking 555 crowns to potentially make 945 crowns if you do see Axe Foods break back above towards that 220 level here to the upside. So having roughly a 2-to-1 risk to reward ratio using a call spread like this, from my perspective, makes sense, because if after earnings, and this is something that you can model out, so let's say a few days after earnings, let's say the stock drops to 199 all the way down to here. And let's say it reports earnings here on April 22nd. So maybe on April 25th or so, a few days after earnings, the market comes down here. Out of the $555 I'm risking, I'm actually only risking about $360 if it does decline substantially after earnings and comes all the way down to this 199 level here, or maybe 200 level here to the upside. You know, I'm risking about 335 crowns out of my 550. But then if it does jump here on earnings, let's say it jumps up to that 220 level, I'm looking at about $470, 470 crowns in terms of profits. And if I can hold this to expiration, that's really where the time decay starts to work in my favor. So this is, I have all the way until June for this trade to potentially work out here. So if it does start to move higher, maybe it doesn't reach 220 immediately, but it slowly grinds its way higher here over a period of time. That's really where the vertical spread here allows me to take on the risk, risking only about 330 crowns here or so. And remember, 330 crowns on a stock that would normally take me about 20,000 crowns to purchase 100 shares is risking only about 1.6% of the stock's value if this trade doesn't quite work out on earnings. So that's the type of small amount of risk that I want to take, so that even if the stock drops dramatically on earnings, I'm only risking 1.6% of the underlying stock's value. But if it does rally substantially higher and I can make 600-700 crowns in profits, then I'm looking at making about 3-4% of the stock's value in terms of profits on a trade like this. So, you know, when you're looking for opportunities, I specifically like the fact that the stock has pulled back substantially in this larger primary bullish trend here. As you can see, you've had multiple pullbacks, and then we're currently sitting in one that looks similar to this. And that is the opportunity that we're looking for to the upside, with about that 2-to-1 risk to reward ratio and limiting our risk using a strategy such as a debit spread. You can also take a look at selling a credit spread, but the risk to reward isn't particularly strong here. Selling the May 205, 195 put spread here only collects 270 crowns out of a 10 crown wide credit spread. So I'm only collecting 27% of the width here. When you're selling a credit spread here, you usually want to try to collect closer to 33% of the width. So when I'm only collecting 27% of the width, not very attractive, because my risk to reward ratio is almost -3-to-1, because I'm risking 730 crowns to try to make only 270. So I'm risking almost triple the amount of max profit I can make. So those risk to reward ratios, in my opinion, is not very attractive. And that's why when I'm looking at this type of trade, I would prefer buying a debit spread versus selling a credit spread. The next one I want to take a look at is JM. And this is really, again, taking advantage of this industrial opportunity here. And this is a stock that has recently cleared its all-time high above that 312 level here, broke out above that 312 level, is now coming back to retest this level as support. And that is your opportunity here to the upside. Again, trying to, when you have stocks that have broken out, come back to retest this level as support, and you're looking for this as a long position here, it tends to favor using call spreads like this, but we can take a look at both. I would go out to probably June. This reports earnings here on April 28th. You can choose between the May or the June expirations. I tend to find that by going out to June, I'm only spending as you can see, the May ones cost me 1,260 crowns for one contract. If I go out to June, it would cost me 1,300 crowns. So only about 100 extra crowns buys me a whole extra month. This is where I tend to prefer spending that extra 100 crowns and getting a whole more month for this to potentially work out, especially as we may be concerned about a pullback here in the short run. This may see a little bit more of a pullback here before it continues moving higher. So you want to give yourself a little bit more time. And I tend to find that buying a debit spread might work. You can also look at selling a put credit spread here as well. But if let's see 320, 300 put spread here, I'm only again collecting 520 crowns for a 20 crown credit spread. So that's again about 25, 26% of the width. So I'm risking roughly 3 times what I can potentially make. I'm risking 1480 versus only making 520. That's not the risk reward that I really like. So I much prefer buying a debit spread here in this particular instance. I'm risking roughly the same amount of capital. The credit spread actually risks a little less. I'm sorry, the debit spread actually risks a little less, but my potential reward is more than triple what I can potentially make on selling that credit spread. So, and you also have the potential catalyst here on April 28th that could use, that is the catalyst that could propel this stock substantially higher here to the upside. So when we're looking for opportunities, we really want to make sure that we spend the time looking at not only the broader markets here, and I know that the Stockholm markets have a higher risk of a pullback, but like I said, these types of scenarios that we see where markets are overbought, they can remain overbought for periods of time. So that in itself is not a good reason to not look for opportunities, especially since the Swedish markets are the strongest of the 4 Nordic markets. You just want to be selective in terms of which sectors you choose. And even within those sectors, the stocks that you choose, looking for stocks that have pulled back here a little bit near a support level, because then the risk to reward is in your favor, right? Because if the stock starts to pull back into this 306 area, I would start cutting my losses. You're risking just a small amount of the downside, but the upside that you see here is substantially larger in comparison to the downside that you have. So whenever you're able to buy a stock near a support level, that's when you skew the risk reward in your favor. And then you can further skew the risk reward in your favor by utilizing option strategies like this, where the amount that you're risking is relatively low in comparison to the potential reward that you have here to the upside. So that's how I'm currently viewing these types of stocks here right now. And then just looking at the Copenhagen market, I don't have anything in particular to look at, but one of the things that we do use the watch list for is by sorting by the score. And this is something that you can utilize to help find your own opportunity. So let's say you're bullish here on the Danish markets and you want to find some stocks that are bullish here in the Danish markets. Well, our Danish derivatives watch list is really designed, you have the watch list for all of the markets, but when you sort by the score, it gives you a sense for which stocks are outperforming the Danish market. So these 7 through 10 are the stocks that are outperforming the Danish 25 index. And then the ones here at the bottom of the list, the 1, 2s, and 3s, these are the stocks that are underperforming the Nordic, the Copenhagen index. So this gives you a good sense for if you're looking for bullish opportunities within the Copenhagen markets, where you want to pay attention to. I'm not familiar with a lot of these names. I am familiar with Danske Bank. I'm familiar with Carlsberg. I'm also familiar with this bank, but I'm not familiar with a lot of the other names. But even if I'm not, as you can see, I've been able to narrow down the Danish markets to just a handful of symbols that I want to pay attention to here. So when I look at this particular stock, I see a bit of a double top here. That's a bit of a concern to me when you see a double top. So that might not be my top choice. Now, when I look at this particular symbol, notice how the 1 month trend has turned negative and the 6 month trend have turned neutral. So this is a strong stock, but maybe that performance is starting to come to an end here. So this is one that I would probably stay away from. I'm looking for a bullish opportunity because, as you can see, that bullish trend has stopped and has started to reverse lower here. And I can tell that just by looking at the color of the symbol without even looking at the chart. So I would probably focus my attention on these 6 stocks that are green. As you can see, they have the the green arrow to tell me that the trends are still bullish. And I know the scores are high, meaning they're outperforming the broader markets. So looking at Carlsberg, so Carlsberg, as you can see, very strong stock, recently broke out above this $1,000 level here to the 1,000 crown level here to the upside. Now it has had a pretty big move here to the upside over the past few days. So perhaps I'd wait a little bit for a bit of a pullback here before I look for a long opportunity. But this is certainly one that I'd probably put on my watch list. Danske Bank, same thing, recently breaking out here. So this is sort of a breakout here, not a very strong breakout here, but it has pulled back here, and potentially that is the opportunity, especially if we see financials continue to outperform here. This is one that you might want to take a look at. You have mostly financial institutions here that are here, but these are the strongest names. These are the ones that have the highest probability of continuing moving higher, because not only are they outperforming the broader markets, not only are they performing the Copenhagen markets, they also have 1 month and 6 month bullish trends. So you can do this across all the markets if you're looking for strong opportunities like this. So in the Copenhagen market, I would look for strong opportunities. If I'm looking at we don't have the Norwegian equities because those are traded on the Oslo bourse. But if I'm looking for the Swedish markets, if I'm looking for some bearish opportunities, then this is what I would look for. Something with a low score and perhaps something that is relatively weak, like AstraZeneca. As you can see, it's red across the board. That's telling me not only is this a weak stock, it's a stock that's trending lower here, as you can see, starting to break lower here. So these are some of the opportunities that if you're looking for bearish opportunities, look for weak stocks, meaning low scores, and also trends that are continuing to move lower here. These are stocks underperforming the Swedish index, and they are exhibiting bearish trends. That's how you can look for some opportunities here as well. Autoliv here, as you can see, the 1 month trend recently turning mildly bearish here, or turning bearish here. This one doesn't have options on it. This one, as you can see, relatively neutral trend here. Clearly losing some momentum here to the upside, perhaps starting to come to the downside. Just by looking at the color of each symbol, you can get a sense for where a stock currently is trading, whether it's trending higher or starting to trend lower. So with that covers what I wanted to share with you here today. Before we finish and open this up for Q&A, I just want to remind investors, we have recently launched a new Learn to Trade Options course from the content that we produced. And it's organized for you in a beginner, intermediate, and advanced options course. So if you started to if you felt that you needed some more information regarding the option strategies we discussed here today, I do talk about debit and credit spreads in our intermediate course. We talk a little bit about it during our beginner course, but we really talk about it in terms of credit spreads, in terms of debit spreads in the intermediate course. This is all available to you free of charge by going to this link, trade.optionsplay.com/NordicEDU. I highly recommend, if you're still in the learning stages of options, if you want to improve your options trading knowledge, this is a course. It's 4 courses in each section. So there's a total of 12 portions to this course. That's going to help you better understand these option strategies, the option concepts, and how to utilize OptionsPlay that you can leverage to find opportunities and quickly analyze an option strategy before you execute it. And just one thing to remind everyone, we also have this short code that we've now added to the platform. You can copy and paste that into your Nordnet account. You can copy and paste that into your Avanza account, and you'll be able to pull up the exact options that we are looking at within OptionsPlay, so that you know that when you translate a trade from OptionsPlay to your brokerage account, that you have the direct link to the brokerage account. So that's something that I wanted to show you guys here today. So with that covers what I wanted to share with you. I hope that this was helpful in giving you a better understanding as to how I think about the current markets, how I use the charts to determine where are there better opportunities, where are there worst opportunities if you're looking for bullish or bearish, and how to look at within the sectors where there's outperformance and underperformance, and whether you should be looking for more defensive plays, especially if you're concerned about a pullback, and how do you look for perhaps even some bearish opportunities in this current market. So with that, what I'll do at this point is I'll open this up for Q&A. There's a chat window and a Q&A window here at the bottom. Or I'm sorry, there is, a chat window and a Q&A window here. If you have any questions, please type your questions into the Q&A window, and I'll answer any questions that you may have regarding options, regarding the current market, out of that Q&A window. So thank you so much for your time here this evening. Anders, thank you so much. I really appreciate that. Any questions, just type it into the Q&A window and I'll answer your questions out of that. Sigvard's asking, do you have any comments on VIX and skew index? I'm not sure that I really have a big comment here on the VIX. So the VIX has been very quiet here in the $17 level. The one thing I will say is that the VIX term structure is very complacent right now, meaning if I'm looking at the VIX futures going out 3 months, going out to the July futures, they're about 23% higher than the front month VIX, which is the April futures. That type of extreme level is not common, and it's generally seen as a contrarian and bit of a complacency indicator, meaning the front month is getting a little too comfortable with the markets and perhaps underpricing the pullback risk here. And I think you largely see that across equity markets around the world. The volatility is at a very, very historical volatility and implied volatility as at a all-time low. That's what the VIX is measuring. And when I say all-time low, I mean since the start of the pandemic. As you can see, when we started the pandemic, the VIX was at 22. We're now at the lowest point we've seen since the start of the pandemic. So markets are kind of very quiet and very complacent here right now. That is concerning. And especially when you look out to July, the 3-month VIX futures, it's pricing in, a substantially higher volatility. The VIX 3 months, the July futures are trading at 20. So substantially higher here. And that's really some of the concern that I have with the markets. As far as skew goes, what we're seeing is that out of the money call options are more expensive than out of the money, or just as expensive as out of the money put options. Historically, that hasn't been the case. The smile used to be that put options were more expensive than calls. So puts here were more expensive than calls, but what we're starting to see is a smile that looks just more like a normal smile, where out of the money calls are just as expensive as out of the money puts. Now, this only applies here to the US markets. It doesn't apply to the European markets. But when you see a normal smile like this, that means that you do have a higher opportunity to generate more premium by selling call options than you do normally. So the skew index is telling us that right now in the US, it favors selling call options versus normal times. Greta is saying, Auntie is saying, great to see quickly how you work with the trading portal. Thank you. I did build the trading portal, so it is relatively natural for me to use. I understand that, for everyone that may not come naturally. So it's really important that you take the time to go through that options education, because during that education, I spend a lot of time showing you the platform and showing you how to use it. It'll be very useful for you to, look up the strategy that you're interested in trading, because I will teach you how to use the platform for that strategy. This way you'll learn how to not only learn how to trade the strategy, you also learn how to use our platform. Yes, we are working on the delta drop down and the strike list. Yes, that is something that we are currently working on. Jonas is saying, is it possible to list your options from your options ranking number in the circle? So Jonas, we can't rank based on just the options play score, because the options play score, first of all, is just telling you whether the risk to reward on an option is in your favor or not. And there are literally infinite numbers of combinations of options. And just because something has a slight edge does not mean you should trade it. Because, for example, if let's say put options are a little cheap on this particular stock, right? Just because put options are cheap does not mean you should buy a put, because you should only buy a put if you believe the stock is going to make a big move to the downside. And when you believe that the stock is going to make a big move to the downside, whether a put is expensive or not is not necessarily going to be the reason whether you buy the put or not. It just gives you a sense for whether these puts are expensive or not. Whether a call or a put is cheap or expensive in itself is not a good enough reason to buy it or not to buy it. That's the one thing that I want to help investors understand, is that the options play score is meant to give you a better understanding of the comparison between the three. It's not to say that this is a good trade. This is just to tell you that the risk to reward ratio on this particular trade is slightly in your favor. Meaning if you traded this 100 out of 100 times, this one trade, meaning this is trying to tell you that perhaps during normal times, instead of costing 620 crowns, maybe during normal times, this would have cost 650 crowns. So saving that 25 crowns is not going to change the trade drastically. It's not going to be the reason that you buy the put or don't buy the put. It just gives you a sense for whether something's slightly in your favor or perhaps slightly against you. So that's why we don't sort by the options play score, because it's not a good enough reason to say, yes, I'm going to trade this, or no, I'm not going to trade this. Any other questions? Yes, we are currently exploring the providers that could provide us with historical volatility information so that we can calculate IV rank. It is something that we are actively working on here at the moment for the Nordic markets. We would be able to cover Sweden and Copenhagen, I believe, for the Nordic markets. I don't know yet if we're going to be able to cover the Helsinki markets, but definitely for Copenhagen and Sweden. If there are no other questions, I just want to thank everyone for taking the time out here this afternoon. Or this evening rather, and I really hope that you guys find this useful in giving you a better understanding as to how I'm viewing the Nordic markets from a technical perspective, how I think about opportunities in this market, and how I specifically use options to limit my risk, especially with earnings season coming up. There's going to be more volatility. It's likely going to produce some interesting opportunities here as well. It's just very important that when you express those interesting views in the market, you do so in a way that limit your risk, because you never know where the markets are going to go. You don't have control over where the markets go. The one thing you do have control over is how much you risk. And options really provide you with the tool to limit the amount of risk that you take, so that if the trade goes south, you know exactly how much you can lose no matter what. You cannot lose more than, for example, what you pay for a debit spread. So very, very important tool in maintaining long-term profitability in your portfolio is by controlling your risk and knowing that when you're wrong, you don't blow up your entire portfolio because of it, because you've controlled that by using an option contract. So with that, thank you so much. I hope you guys have a great trading day. We'll send you the recording as soon as we finish processing it. And if you have any questions, you can always reach out to us by clicking on the questions ask us button here on the OptionsPlay platform, and that will send a ticket to my support team and will help you answer your questions with respect to options trading. Thank you so much, and I hope you guys have a great evening.